Hello, very good morning to all, and welcome to today's Daily Dose of Market Insights. I'm Kelvin here. Very good morning. Today will be Tuesday, the 14th of May, 2024. So before we start our Daily Dose of Market Insights, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial recommendation of any investment product, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so this will be the usual, we call it a flow of our daily dose of market insights. So before we jump straight into the short-term technical outlook on the major US dollar pair, the major stock indices, and as well as the two key commodities that we cover, Gold XAU/USD and West Texas crude oil, let's have a recap at what has taken shape yesterday in terms of key economic data and as well as events and the broad-based performance of the cross asset classes. So let us start with the US stock market first. So in terms of the US stock market, yesterday was a rather lackluster session. If you could look over here, is that the major US indices more or less is in a kind of a profit taking mode, or I would say there's more of a cautious mode at the start of this week. The S&P 500 almost unchanged at negative 0.02%. The outperformer is the Nasdaq 100 up 0.21%, the Dow Jones down negative 0.21%, and the Russell 2000 up positive 0.11%. So the performance of the Nasdaq 100 has been pretty much been supported by the rosy outlook on the rosy performance of Apple and Nvidia. So if you look at the S&P heat map yesterday, 1 second, it's being hanged. Okay, it's been driven by Apple. That's up 1.76%, and the more or less the rosy performance on the semiconductor sector, where Nvidia gained positive 0.6%. All right, so overall is in terms of the overall market breadth wise is rather weak, not really that bullish at all. So you could look at the entire S&P component. More of them are in the red or almost unchanged rather than positive by looking at the color of the heat map of the S&P 500. So what we could see over here is that yes, market is actually kind of a bit cautious. Why? Because this coming Wednesday we do have a risk event, which is the release of that US CPI data that is out on Wednesday. Why is it important? Because that particular data will kind of dictate the stances, the latest monetary policy stances of the Fed. So if that data come in very hot, that means that could also reduce the chances of future interest rate cut going forward in 2024. So like I explained to you, like highlighted yesterday, based on the CME Fed Watch 2, market is still expecting 2 interest rate cut before 2024 ends, penciled in the month of September and December FOMC. So let's have a quick look on the CME Fed Watch 2. So it's free, it's available on the just Google CME Fed Watch 2, you're able to get it. It's not live, it's about delayed about half 30 minutes or 20 minutes or so, but that should be sufficient to actually for us to have a gauge what is market is expecting in terms of the interest rate cut expectation based on the current market pricing of the interest rate futures market. So if you look at the one in probability, just click on probability here. So this, you look at the cumulative probability, we see for sure 75% chance of the first cut to come in the September FOMC meeting. All right. So current rate is at 5.25%, 5.5%. So if you look at 5% to 5.25% is imply a 25 basis point cut. So 75% chance of it. And the next one will have a 61% chance will be in the December meeting, okay, to bring the Fed fund rate down by another 25 basis point to 4.75% to 5.5% to 5%, pardon me. So if this Wednesday CPI data came in hotter than expected, especially the one that is being fleshed out on the services side component. So I'll touch on more about the CPI component tomorrow. That could also reduce the chances of these metrics that's being portrayed over here at this point in time. So that could also create a bit of short-term negative feedback loop into the market. And I want to highlight to you all what's going on yesterday in the US market. It seems to be that this particular meme stock is actually coming back. All right, so as meme stock, those who traded in the US stock market during the pandemic years of 2021, you have this guy called Roaring Kitty. So he's the poster child for GameStop. We see a short squeeze rising about 100%. So yesterday, this guy, Roaring Kitty, he actually posted a picture on his Twitter handle that causing the GameStop price to actually rally up to 60% yesterday. So what we could see over here, it seems to me that that kind of exuberant behavior in the US stock market seems to be coming back into the market again. So something to keep an eye to watch out for. How does this spill over? So this is the price of GameStop is actually up yesterday by 74%. So yesterday price, the intraday movement of GameStop over here. So based on Friday closing price. So yesterday the intraday high was 38.2. Okay, so if you take into account of the intraday movement, it actually rallied up to almost as 113% in a single day. So that kind of crazy, or what I call irrational movement on the part of the US stock market seems to be coming back. But how does it impact the overall US benchmark indices? This is something we got to pay attention to. That doesn't mean that at this point in time we already hit a tipping point where irrationality is at the peak, where potentially it may not be look good for the major US stock indices possible, but something to pay attention to in the days ahead, especially its movement being spilled over to the US major stock market. But for sure, the major US stock market, what market is concerned right now is still that potential stagflationary risk scenario that is being portrayed by the University of Michigan data that is not that rosy. Why? Because consumer confidence in US as being surveyed by University of Michigan tick down to 6-month low, but inflationary expectation from a 1-year and a 5-year basis as surveyed by the University of Michigan data actually tick up higher to a 6-month high. So this I really highlighted in yesterday daily dose. You can actually look back at the daily dose video for that particular data set. So but market choose to ignore that. Why? Because market is still pretty much rosy in terms of higher earnings growth in the US stock market as portrayed by the current state of the earnings results. All right, so overall that's the take of the US stock market yesterday. So in terms of the FX market, so if you look at the FX market right now, okay, let me highlight to you all the FX market. So dollar strength continue to be rather strong on the US, on the yen side of the story. So if you look at the 5-day rolling performance chart of the US dollar, that's going to be out in a while time. Okay, give me a couple of seconds to load it. Okay, so this is the 5-day rolling performance of the US dollar against the rest of the other currency. Okay, so let me change this date to 14th of May. Okay. Okay, so for sure what we could see is the very strong dollar strength coming into the yen, but whereas the rest of the other currency continues to remains in a sideways range configuration. The one that is coming out will be the dollar CNH as well. Why? Because of this potential we call it competitive export, we call it story that could actually lead to the China top policymaker to, instead of making the yen, the dollar Chinese yen much weaker against the dollar, to maintain export competitors, but export competitors in China products against the rest of the world. But the rest of the other currency continue to remain traded. One health 5-day, okay, remains sideways, like the dollar Aussie, the dollar Kiwi, the dollar Euro, the dollar CAD, and the dollar Sterling almost unchanged. So the big movement was the dollar Yen. So the dollar Yen over here is that one of the reasons I shared with you today because was the breakout of that 156.30 level. So now you'll be inching potentially higher towards the 157. So those who actually follow our data of market insights, we do highlighted some short-term bullish technical elements has starts to creep out in the dollar yen since 1.5 weeks ago. So later we will revisit the technical chart of the dollar yen, but be patient, all right? But one thing I want to highlight to you right now, the fundamental movement of the dollar yen right now doesn't seem to be supported by the spread between the US Treasury yield and the JGB yield. Okay, what do I mean by that? So very quickly, let's look at this fundamental chart. Okay, so what we could see over is that, oops, not this one, yeah. So what we could see over here is that the 10-year and the 30-year and the 2-year JGB yield has been rising very, very steeply in the last 2 weeks. All right. So in fact, the 30-year and the 2-year JGB has been the 2-year JGB now is at 0.35%. Is now trading at a high that was not seen in May 2009. Similar for the 10-year JGB yield as the 30-year JGB yield as well, trading at a level not seen in July 2011. And also the more sensitive, the one is the 10-year JGB yield. We know that at this point in time, the Japanese central bank is no longer doing yield curve control program, but they are still looking to actually control the pace of appreciation by the JGB yield by targeting the 10-year JGB yield as their monetary policy. So you look at the 10-year JGB yield right now, it's now inching closer to 1% mark. So it seems to us that the BOJ right now is totally not so concerned about the rise in the 10-year, in the JGB yield, okay, in the JGB yields by looking at the 10-year as a policy. Okay, so that means less bond buying to suppress the yield of the JGB. So with that, if you look at currently, okay, so let me reduce this, reduce this, reduce this, reduce this, reduce this, reduce this, okay, reduce this, reduce this, and reduce this. Okay, now this is the yield spread between the 10-year and Treasury yield against the 10-year JGB yield. So right now, yes, the 10-year JGB yield, the 10-year Treasury yield minus off the 10-year JGB yield is still trading at a premium at 3.53%. But however, the medium-term uptrend since the low of 31st of January this year has been broken down on the downside with a break of the 3.61%. Very similar to the 2-year Treasury yield minus the 2-year JGB yield spread as well. It's been inching downward and is broken below that medium-term uptrend that is in place since 30th of January and the breakdown of that 4.57 support level. So what it means over here is that the yield premium between the 10-year Treasury yield against the 10-year JGB yield and the yield premium of the 2-year Treasury yield against the 2-year JGB yield has starts to narrow down. So with this narrowing of this US yield premium over the JGB yield premium, it actually represents to us that now as a Japanese investor to actually convert my JGB yield, as a Japanese investor now to convert my yen back into US dollar and invest in US Treasury, the profit potential is getting lesser. Why? Because of the yield premium shrinkage that I explained to you all by this yield spread between the US Treasury yield and the JGB yield. So it's no longer as attractive as before for a Japanese investor to convert my yen and invest in US Treasury. So that fundamental aspect of it actually doesn't support the continuation of strength of dollar yen, okay, based on this fundamental linkage. All right, so with that in mind, we got to be a bit more cautious of this ongoing strength of that dollar yen that is playing out in the FX market. Okay, so that's from a fundamental perspective by looking at the yield spread between the 10-year US Treasury against the yield of the respective JGB 10-year and the 2-year GGB yield. All right, so that in mind, gold XAU USD continues to remain supported yesterday above the 20-day moving average support, okay, because of that fear of that stagflationary scenario that is still playing out in US. And as well for WTI crude oil. So crude oil yesterday managed to recover at the 78.40 medium-term pivotal support that we have been watching so far in the West Texas oil instrument. Then the only thing that is going against this stagflationary trend is still the US stock market that are still be trading on the optimism of rosy earnings growth potential. And what we see over here is that over at the German stock market, which is a representative of the European stock indices, managed to actually kind of do that profit-taking scenario after being the outperformer against the rest of the world last week. So with that, okay, so that pretty much sum up the intermarket performance of the cross asset classes in tune with the respective fundamental intermarket linkage that I've highlighted earlier on. So with that set aside the fundamental side of the story. So now let us now dive deeper to the short-term technical outlook, okay, on the various cross asset classes. So let us start with the benchmark major stock indices first, okay, starting with the Hong Kong 33 index or the Hang Seng index. So with that, let me expand my screen so that you guys could see. So on the Hong Kong 33 index over here, what we could see is that the price action continued to inch higher, right, and almost hit the first resistance that we highlighted yesterday, 19,390. So with that, the RSI also exited from the overbought region. Okay, so no change. The Hong Kong 33 index continued to remains bullish in a short-term bullish uptrend dynamic since the low of 19th of April. So with that, we will actually have a much more tightened key short-term pivotal resistance, pivotal support for today to maintain this short-term bullish bias on the Hong Kong 33 index, which is at 18,680. So what's 18,680? Very clearly the former range resistance of 30th of May, 3rd of May, pardon me, not 30th May, 3rd of May to 6th of May and 9th of May, bullish breakout. And right now, this is the pullback support and also confluence with the lower limit of this lower boundary of this ascending channel that is in place since 2nd of May. So as long as 18,680 short-term pivotal support holds for the Hong Kong 33 index, i.e. the Hang Seng index, we will still maintain that short-term bullish trend configuration of the Hong Kong 33 that is still at play, with the next resistance coming in at 19,980 after 19,390. Only an hourly close below 18,680 will put this short-term bullish uptrend scenario in jeopardy, where the Hong Kong 33 may see the start of a corrective pullback scenario unfolding to expose the next support level at 18,240. A break below it sees 18,000/17,900 next, which also confluence with the upward sloping 20-day moving average as well that is soon coming to act as a support level at this 18,000/17,900 level. The Nikkei 225 or the Japan 225, no change, going to trade within this complex sideways range since the low of 19th of April. So yesterday we flipped to a bullish bias because it's traded close to the lower limit of this minor range configuration that has taken form since the low of 9th of May over here. Okay, so early today Asia session, it managed to hit up the upper limit of the range before trading back down again. So no change, do expect to evolve within this range configuration since now it's at the lower limit of this minor range configuration. Within a medium-term range configuration, we will still maintain that short-term bullish bias scenario within this minor range of 38,010 as a key support level. So as long as 38,010 didn't surpass to the downside, potentially it could still converse in this minor range configuration with the upper limit of the range coming in at 38,610 level, which confluence with the minor swing high of 10th of May and as well as this minor descending trend line that I drew from the high of 22nd of March, now also acting as a resistance at 38 38,610. Only an hourly close below 38,010 will invalidate this bullish bias scenario within this minor range configuration to expose the lower limit of the medium term range at 37,680. A break below this level exposes the next support level at 37,070 for the Japan 225. German 30 or the German DAX going to shape that minor pullback below the below the key short-term pivotal resistance that we had yesterday at 18,910 level. So still no change using 18,910 as a key short-term pivotal resistance for this potential minor pullback corrective scenario to play out. First support level to watch 18,600. A break below it exposes 18,470, and the daily RSI continues to remain lackluster below the 50 level and continues to actually trend downwards. All right, indicating the lack of upside momentum as well. Only an hourly close above 18,910 will invalidate this potential minor corrective bearish pullback scenario to continue the impulsive up move sequence within its short and medium term uptrend phase that is still intact, because price action going to trade above the 20 and the 50-day moving average, and the 20-day moving average now trade hovering above the 50-day moving average. The next resistance after 18,910 will be 19,030/70, followed by 19,230, which is a Fibo extension level. US indices, the Dow Jones Industrial Average managed to pull back and hit the first support level yesterday at 39,360. As long as 30,050 short-term pivotal support level holds, which I highlighted yesterday, still maintain that short-term bullish uptrend scenario phase for the US Wall Street 30 index, i.e. the Dow Jones Industrial Average. Next resistance to watch out for 39,775, followed by 40,020, which is the current all-time high area. Only an hourly close below 39,050 will put this bullish tone in jeopardy, where we may start to see a much more steeper corrective pullback scenario unfolding to retest the 50-day and the 20-day moving average, acting as a support at 38,750, 38,560 level. Nasdaq 100 traded sideways yesterday above the first support level at 18,120. So still no change. We use 17,970, which is the 50-day moving average, I think, as a support. This level here will be a pivotal support to maintain this ongoing bullish tone that is being seen on the US Nasdaq 100. Next support level to watch will be at 18,380, which confluence with the upper limit of this ascending channel, that is the price action that is still hovering inside it since the low of 19th of April, and this 18,380 also confluence with the minor swing high area of 5th of April and 12th of April. Above 18,380 will expose the current all-time high area at 18,500. Only an hourly close below 17,970 will negate the bullish tone to open up the gates for a potential much more steeper corrective pullback scenario. Next support level to watch will be at 17,810, followed by 17,685, which confluence with the 20-day moving average, acting as a support, and as well as the lower limit of this minor ascending channel that is acting as a support, similarly to 17,685. Okay, so that's pretty much sum up for the major stock indices short-term technical outlook. Pretty much mixed bag across the board in terms of the technical analysis, short-term technical analysis. Now, going on to the Asia Pacific currency. So let us start with the Aussie dollar. So Aussie dollar continue to trade sideways below the short-term pivotal resistance at 66.45. So still no change using 66.45 as a short-term pivotal resistance level. The Aussie dollar got to break down below the first support at 65.85 before potentially seeing much more minor weakness on the Aussie dollar to expose the next support at 65.50/65.20, which is the 50-day moving average and the 200-day moving average, acting as a support area, as this zone area as well. However, an hourly close above 66.45 will negate this or invalidate this short-term bearish tone to see the continuation of this corrective rebound scenario within its medium-term symmetrical triangle range configuration that is still at play. Next resistance level to watch will be at 66.80. Above it exposes the key medium-term resistance of 67.30. So 67.30 on the daily chart very clearly is actually the upper limit of this symmetrical triangle range configuration, where the price action of the Aussie dollar still remain trapped since the low of 13th of October last year. Dollar yen, so this is where my concern comes. It's now approaching the 157 resistance level that we highlighted yesterday. Also, the golden ratio of that 61.8 FIBO retracement of that previous down move from 29th of April towards 3rd of May. And this down move has been more or less been induced by the so-called alleged MOF instructed instruction by the BID to instruct BOJ to intervene in the FX market to actually sell dollar, buy yen. So now it's approaching this resistance level at 157. So and RSI also at the overbought level, but there is no signs of a bearish divergence. What do I mean by that? Because price action in the RSI remains at a higher high in line with the price action on the raw price action of the dollar yen. So with no bearish divergence, I do not want to turn bearish, outright bearish here. So I was instead flip to a neutrality stance for today on the dollar yen, neutral between 157 figure and above this yesterday breakout level now turns into a minor pullback support at 155.90, slightly above the 20-day moving average at 155.30. So neutral between 155.90 and 157 level on the dollar yen. Now European currency, so on the euro dollar managed to actually kind of retested the short-term pivotal resistance level at 1.08, which is the 200-day and the 50-day moving average before trading down lower, and thereafter it just traded sideways in the Asia session. So no change for sure. This is a very clear pivotal resistance level to watch, 108. So as long as 108 short-term pivotal resistance level holds, we still keep that minor bearish bias scenario for the euro dollar intact. First support level to watch right now will be at 1.0755. Only a break below 1.0755 exposes 1.0730, which was last week low, and as well as the 20-day moving average will be soon acting as a support at this area as well. However, an hourly close above 1.08 will put this dollar strength revival story in jeopardy, where the euro dollar could further much extend this ongoing corrective rebounds sequence that is in place since the low of 17th of April to extend it to expose the next resistance in near term at 1.0850, followed by 1.088, which is the minor swing high area of 9th of April. And as well as close to the 50% FIBO retracement of that previous decline from the low of the 28th of December all the way down to 17th of April. Okay, that's for the euro dollar. The sterling dollar, similar as well, hit the short-term pivotal resistance before trading sideways. So no change. This is a very clear pivotal resistance level to watch for today again, 1.2565. So as long as this level not surpassed to the upside, potentially there could be a bit of minor retracement down on the sterling dollar. First support level to watch will be last Friday minor swing low at 125 figure level. Only a breakdown below this figure 1.25 figure level exposes the 9th of April minor swing low area, which correspond to the 26th of April swing low at area at 1.2460. So in terms of technical analysis configuration, this particular configuration over here could be potentially a minor bearish reversal formation. Why? Because this is a, let me put it in pink. Okay, this could be the head and shoulder formation. Okay, this is the left shoulder, this is the head, and this one here is the right shoulder. So the neckline support level of this potential minor bearish in head and shoulder that is forming could be potential is the 1.2460. Only a breakdown below 1.2460 will validate this bearish head and shoulder breakdown scenario, but that could take a couple of days time. So definitely the potential catalyst could be this coming Wednesday US CPI data. So now I'm trying to actually take into account of technical analysis, price configuration in line with upcoming key fundamental risk event, which is the US CPI data release on Friday, not on Friday, on Wednesday, pardon me. Okay, so for sure, if today, if we start to see a breakout above 1.2565, then forget about this potential bearish minor head and shoulder formation. This will be invalidated to actually kickstart another round of corrective rebound scenario sequence. In first step, to retest the 3rd of May swing high area at 12640. Above it exposes 12710, which is the minor swing high of 9th of April and 10th of April. Okay, so that's pretty much sum up for the FX market. So the FX market, what we could see is that the dollar still remains on support level, but however, cautious of the dollar yen. Why? Because it's now approaching a key resistance at a key short-term resistance at the 157 figure level, as I highlighted earlier. So now very quickly, what do we see in spot gold? So spot gold over here, XAU/AUD. Yesterday we see the profit taking scenario take shape, but however the profit taking scenario managed to actually bounce off exactly at the 20-day moving average and slightly above the tighter key pivotal support that we highlighted yesterday, 200327. So no change. RSI also managed to bounce off close to oversold level, so indicating to us that there's some form of potential short-term bullish momentum coming back into the market to stabilize yesterday's slide. So no change as long as 200327 short-term pivotal support holds for XAU/USD. Gold still maintain that short-term bullish bias on gold, or for this short-term trend to actually be to continue to evolve. So if you look at the current price action, it could be potentially evolving in a short-term bullish ascending channel. Okay, over here. So net overall, first resistance to watch will be at 2007.8, which was last Friday's swing high, followed by the top of the channel, which is at 2003.87. Above this range, 2000, okay, above this range of 2003.78, 2003.87, potentially could see a revisit of the current all-time high area at 2004.20. Only hourly close below 2003.27 will put the bulls in jeopardy to see another choppy corrective movement. Again, to retest the psychological level of 2003.0, if 2003.0 giveaways, it will potentially expose the key medium-term pivotal support area at 2265/2260, with so confluence with the upward sloping 50-day moving average. West Texas Oil, yesterday we see a recovery and managed to survive at the 78.40 short-term pivotal support level. So all in all, yesterday price action indicate to us that this medium-term uptrend phase from the low of 13th of December last year still remains intact. Why? Because there is so far no daily close below 78.40 level, but price action still remains below the 200-day moving average. That means, i.e., lacking some form of upside momentum for the recovery to be much more substantial. Okay, so going forward in a shorter term basis, we still expect a bit of choppy sideways movement. So we will still maintain that neutrality range for today at 80.30, 77.50. All right, 77.50 is last Wednesday's minor swing low. So however, only a clear breakout above 80.30, that means, i.e., an hourly close below 80.30, we could actually see a much more substantial short-term bullish intraday movement to expose the next resistance at 81.70. Once 81.70 is confluencing graphically as a resistance, and as well as the 50-day and the 220-day moving edge also acting as a resistance at around this 81.70 level. Okay, so that's for West Texas Oil. So that's pretty much sum up for today's short-term technical outlook across the broad-based asset classes. So before we go, what are the key things to look out for calendar for today? So more on the Asia side of the story that could impact the Hong Kong 33 index and the Hang Seng index, i.e., will be the key earnings of the key component stock of inside the Hang Seng index, which is Tencent Holding, that is out later today after the close of the Hong Kong stock market session, means after the close of the Hong Kong stock market, and as well as Alibaba. So market is expecting a much more rosy earnings upgrade in terms of earnings growth consensus at 4.49 EPS for Tencent, above the previous year-on-year quarter at 3.35. For Alibaba, is rather lackluster at 10.27, slightly below the previous 1 year quarter ago at 10.71. So something to keep a lookout for after the close of the Hong Kong stock market today, where we see the release of these two key components stock of the Hang Seng Index, Tencent and Alibaba, that's out later. In terms of economic calendar, what do we have for today? So economic calendar, what we have is we do have UK labor market data, which is the unemployment rate that is up at 2 p.m. Singapore time, and the unemployment change data that is up also at 2 p.m. Singapore time. Then thereafter, at 5 p.m. Singapore time, we do have one particular German-related data. The ZEW Economic Sentiment Index is a kind of a consumer sentiment index data that is out at 5 p.m. Singapore time, together with the broad-based Eurozone one also releasing at the similar time at 5 p.m. Singapore time for the month of May. And thereafter, we do have, this is not so important, it's a form of inflationary metrics, but the important one is the CPI, which is out Wednesday. So PPI, which is factory gate data in US for the month of April, will be out at 8:30 p.m. Singapore time today. And thereafter, we do have an important data to look out for, will be Federal Reserve official speaking, 9:10 p.m. Fed Cook official will be speaking, and the more important one will be the boss, Fed Chair Powell. He'll be speaking at 10 p.m. Singapore time. So that should actually round up for today's key economic data to look out for. So with that, do have a great day ahead, and we shall speak again tomorrow. Thank you.